Good morning, everyone. Allie Peters over here with the Core Group. We're so excited to have you today. Thank you for taking time out to join us on this webinar. I just want to do a quick housekeeping. We will take questions, but if you can type them into the chat box or there's a question box, either work. I will watch both, and we will make sure to answer them at the end. And with that, I'm going to hand it over to Mike Malone from Protective and let him go ahead and introduce Jody.
Thank you, Allie. Thanks very much. We sure appreciate you inviting us to participate in your webinar today. My name is Mike Malone. I'm a National Account Manager with Protective Life. I worked with Core Group for many years on their annuity business. And again, we're very happy to be able to provide this seminar for you. I am going to introduce Jody Harris. He is our Social Security consultant. Jody worked for the Social Security Administration for over 34 years. 10 of those years he served as a public relations officer. He's held staff member positions to both the commissioner of the SSA and a United States senator. At the time of his retirement, Jody's title was Public Affairs Specialist of Alabama, and that saw him responsible for all SSA education and outreach programs within the state. For his outreach work, Jody received the prestigious Deputy Commissioner's Award, which is the second highest accolade within the Social Security Administration. He's worked with Protective for many years. He always puts on a great presentation. And with that, Jody, feel free to take it away.
All right. Thank you, Mike. And I hope we don't have phone trouble again. It just dropped my call a minute ago, but we're going to see what we can do. Today, we're going to talk about Social Security benefits, and I'm going to try to explain the basics of the benefit, how the program works, where it started, and where it may be headed. It's a large program, and I'm going to cover a lot of information over the next 30, 45 minutes, but we'll get a chance to ask some questions. Please type your question in the chat box so Allie can cover them with me in a moment. We're going to talk a little bit about Social Security, how it started, how your benefits, when to file, some various filing options and things you need to know about spousal benefits and survivor benefits, a little bit about taxes, and then we'll have time for some questions. So Social Security started paying benefits in 1937, but the rules were a little different back then. In 1937, the only person that received benefits was a retired worker. There were no other types of benefits payable. There were no benefits for spouses, nothing for children, nothing for survivors. Only a retired worker, and it had to be at full retirement age. In 1937, you did not have an option to draw benefits before your full retirement age. There was not an early retirement opportunity for people. So you retired at 65 and drawing benefits to the retired worker only. In 1937, life expectancy was 63, so you can see most people never received a payment or only received a payment for a few years and then they died because of life expectancy. But today, life expectancy is much longer. Men can live approximately to 85 and women to about 87 on average. And you have an early retirement option today. So you're paying retirement benefits to more people longer, and you are paying additional individuals payments today. You're paying benefits to survivors. You're paying spouses. You're paying ex-wives. You're paying divorced widows. You're paying disabled people, college students, disabled children. There are a lot more individuals being paid today than were being paid when the system was originally established. So today you have more money going out than is coming in. Since 2010, Social Security has paid out more in benefits than it collected in taxes. That leads us to a question that many of your clients are going to have. They wonder, will Social Security be there for me in the future? Is it going to be there? And part of their concern is what they read in the paper and about the system with the financial struggles. but a lot of it is because they do not understand how the program is financed. Today, there are over 170 million people that they're paying Social Security taxes, and only about 65 million people are receiving benefits. So you have more people paying in that are taking benefits out, but it's not as strong a system as it was in the 1950s. In the 1950s, you had almost 6 people paying taxes for every person receiving a benefit. Today, you have about 2.5 people paying taxes for everyone receiving a benefit. And by 2030, they anticipate that it will be right around 2 people paying taxes for everyone receiving benefits. The current trustee report states that if there are no changes in the current law, they will only be able to pay full benefits until 2035. If there are no changes in the current law, in 2035, the current estimates are that everyone will take a 20% cut in payments. Social Security will be able to fund benefits at 80% of the promised amount for the next 75 years, starting in 2035. And that's a slight improvement over the previous 2 years. The previous 2 years, the 2016, 2017, 2018 trustee report said that the program would run short of money in 2034 and would only be able to pay 75% of the promised benefits. So they bumped the time frame out 1 year to 2035 and increased the payout from 75% to 80%. And that's if nothing changes in the current law. So you wonder, how did it get this way? Well, it got this way because life expectancy lengthened and people are not dying as quick as they were back in the 30s, and the birth rate has fallen. So it's just a numbers game. So we can watch Congress and see what it does over the next 15 years to solve this problem, but it really is a political problem today and not an economic. But it is important that you understand that benefits will not stop, but unless there are changes in the current law, there will be an adjustment downward in the monthly payment amount. So it's not going to be a question of all or nothing. It will be a question of all or something. So a common question I get is, how much could they really be? Well, the maximum benefit this year is $2,861, or $34,000 a year for this person. The average check this year is $1,461. So the average check is roughly half of what the maximum could be. But some of your clients will, they'll say, well, I paid in a lot of money over the last, 10, 15 years. Why am I not getting the maximum? You're not getting the maximum because benefits are based on your highest 35 years of work. One of the several advantages to Social Security benefit, as you can see, the amount could be quite significant. You could get $20,000, $30,000 a year in benefits from Social Security for an individual, and that doesn't count what can be paid to other members of the household. The benefits are adjusted as inflation rises. You cannot outlive your benefits. And when you start looking at survivor benefits, you're not only considering how long will you live, but how long will your spouse live. If they survive you, your benefits could be paid to them. So let's start off with give you a basic understanding of how benefits are determined, what you can control, and what you cannot control. To earn benefit coverage, you have to have 40 credits or 10 years worth of work. If you get 4 credits a year is the maximum you can receive. For every $1,360 in earnings, you earn 1 credit. So you take the highest 35 years of work. It is not like a private pension where it's your high 3 or high 5, something like that. Social Security is based on a snapshot of your entire lifetime of employment. Now, a couple of things you need to understand here when you're looking at your highest 35 years. If you look on your Social Security statement, it has a list of all your earnings, but Social Security does not use actual numbers for most of the years. Social Security takes all the earnings that you had prior to age 60 and indexes those dollars up to what a dollar is worth the year you turn 60. Everything you earn from age 60 forward will be actual dollars, but anything you earn before age 60 will convert to pretend dollars. And a quick example, so say I was turning 62 in 2019 and filing for benefits. Say in 1975, I earned $10,000. That was fair money in 1975, but that is poverty level today. When I filed for benefits in 2019, I actually received credit for almost $57,000 for 1975 because that's the value of that $10,000 today, and you index it up to today. Excuse me. So you can see that your high 35 years, you may say that, oh, this year I made more than what I earned 15 years ago, but the value of what you earned more than 15 years ago may make it one of your high 35 years. So you take your highest 35 years, you average those earnings, so you add them all together, divide it by 420. 420 is the number of months in 35 years. That provides you with your average monthly earnings. That goes in a benefit form, and that gives you your benefit amount at your full retirement amount, full retirement age. So how do you know these numbers? Well, you look at your Social Security statement. The easiest way to get a statement is to go online at socialsecurity.gov, my account, and ask for a downloaded statement. You can get it immediately. You also have statements, paper statements mailed to people periodically, or you can call Social Security's 800 number at 1-800-772-1213 and receive a statement on request. This statement provides you with an estimate of your earnings at your full retirement age, at age 62, and at age 70. So, important thing, you can't control what you've worked and earned over 35 years. That has already happened. What you can control, and the key financial decision you will make, is when do you start payments. The key number here is what is your full retirement age. If you wait until your full retirement age to begin payments, you get 100% of your benefits. If you begin payments early, you can start as early as 62, but benefits are reduced. If you delay payments after your full retirement age, you receive a bonus. The penalty is a fraction of a percent for every month you take that payment early. The bonus is 2/3 of 1%, 8% per year, up to age 70. So you can see you control this, and it can make a dramatic difference. Excuse me, I've got a cold here. And let me just, a quick example. Let's assume that your retirement age is 66. And as you can see, retirement age is changing based on your birthday. But we're going to say that you were born in 1953, so your retirement age is 66. If you begin payments at 62 with the maximum penalty, you will take a 25% cut in payments. You will lose 1/4 of your payment. You will only get 75% of your amount instead of 100%. If you delay taking your benefits after 66 and wait until 70, you would have earned an 8% bonus for 4 years, 32% bonus, so you would get 132% of your payment. And put this in a dollar figure so you can envision it easier. If you would do $1,000 at 66 and begin payments at 62, you would only get $750. If you delayed those payments to 70, you would get $1,320. You can change your payment amount 76% based on what you decide you want to do, and this is the key decision you make. When do you start your payments? Some things you need to think about. How's your health? What's your family longevity? Are you a single income, low income person? Do you need the money today to eat, to pay your bills? Are you still working? Do you have other people that can receive benefits? Is there a spouse? Are there children? There are lots of things to think about other than just, do you want the money right now? You need to look at Social Security as a financial decision, not an emotional decision. Take the emotions out of it. Treat Social Security just like your other assets. So you have decided to file for benefits. When you get ready to file, you're going to be asked a series of questions to help identify, are there other people that can receive payments on your record, or can you receive a payment on the record of somebody else? They're looking to see, is there a spouse? Is there an ex-spouse? Or if you're, well, you wouldn't care. If you're dead, is there a widow? So let's start off and talk some about spouse payments. Your spouse is eligible to receive an amount equal to 1/2 of your full retirement amount if they wait to their full retirement age to start payments. Notice I did not say they get half of your check. They get their own payment on top of whatever you're receiving, or their own, whichever is higher. Before they can file for spouse payments off of you, you must file your own retirement claim. Your current spouse cannot receive anything off of your record until you file your claim. They can file their own retirement claim if they choose to, but they cannot request benefits off of you until you file. When they file for spouse payments, with only one exception, they must file their own retirement claim at the same time. If they file for retirement payments or spouse payments before their full retirement age, their payments are reduced. We've already talked about the retirement benefit being reduced by 25% at age 62. At age 62, the spouse, instead of getting a 50% share, would only get a 35% share. But remember, you're either going to receive benefits as a spouse or on your own record, whichever is larger, and you do not receive both payments. You only get the larger one. And you do not get to pick and choose except for one unique circumstances. So let's talk about the circumstances for a minute. The unique circumstances, in November of 2015, Congress changed the Social Security law back to what it was prior to the year 2000. They did away with the file and suspend option completely, and they did away with the restricted application process, but they grandfathered a group of individuals. A restricted application allows you to file a claim for spouse payments only and allow your own retirement benefit to continue to grow. The only people that can do this today are people born on or before January the 1st, 1954. If you were born after that date, you no longer have that option. If you wish to use the restricted filing strategy, you must wait until your full retirement age to file for any type of payment. At that point, if your spouse has filed a retirement claim, you can file for spouse payments only off of their record and get a 50% amount and let your own retirement benefit grow 8% per year up to age 70, and then switch over to your higher amount. But the only people that can do this are people that were born on or before January the 1st, 1954, and they do not file for any payment before their full retirement age. So that's the only filing strategy there with spouses. So people ask now, well, what if the marriage ended in divorce? Well, you could be eligible for benefits as a divorced spouse. If the marriage lasted at least 10 years and you had been divorced at least 2 years, you can file for benefits as a divorced spouse. If you remarry, you lose the payments off of your ex. So you have to be 62 or older and not married. Your former spouse has to be at least 62. They do not have to file for benefits, but they have to be eligible to file for benefits. So if your ex is at least 62 and you are 62 or older, you can file for benefits on their record. Once you do that, you must file your own retirement at the same time, and you get the larger of the two, not both. So people worry a lot about spouse benefits and divorced spouse benefits, but because today most households are two-income households, less than 4% of the population gets benefits as a spouse or as a divorced spouse. But remember, one of the big differences between the two, your current spouse cannot file for benefits on your record until you file your own retirement claim. Your ex-spouse can file on your record if you are at least 62, whether you file a claim or not. Benefits payable to your former spouse have no impact on anything you receive, nor do they have any impact on benefits paid to your current spouse. So they don't affect you at all. Now, if the marriage ended in death, or if the marriage ended in divorce, and the marriage had lasted 10 years or more, and you are now dead, then they qualify for widow payments. A widow at their full retirement age can receive 100% of what the deceased would have been due had they continued to live. A widow or widower, divorced widower can receive benefits at as early as age 60, but if they take them at 60, they're reduced 28.5%. You only get 71.5% of the payment. If you start payment before your full retirement age, there's a penalty. Now, what I just said was government speak. Let me tell you in English what I just said. When you get ready to file your own retirement claim, you are making a decision about what you will receive today and about what your surviving spouse will receive tomorrow. If you elect to take a retirement payment early, so you are taking a reduced payment, you are capping what your surviving spouse can receive as a widow. They can get no more than you would have received had you continued to live, and you would have been due a reduced payment. A widow or divorced widow can get the bonus you earn after your full retirement age up to age 70, where your spouse could not get that amount. The most your spouse could receive was 50% of your payment. Once you die, your widow can get any bonus you have earned. So if you delay payments after your full retirement age, you are increasing the survivor payment. So when you make a decision to start your own retirement payment, you're making a decision about what you will receive today and what your surviving spouse will receive tomorrow. Another option under the survivor benefits, widow benefits or divorced widow benefits are a death payment, while your own retirement payment is a life payment. Because there are two different categories of benefits, you can always pick and choose between the two. You can elect to take the survivor benefits as early as age 60, even with the 28.5% penalty, and let your own retirement benefit continue to grow up to age 70 and earn that 32% bonus. And then if your retirement payment is higher, you can switch over at that time. Or you can switch over to retirement payments from survivor payments at any time you choose, as long as the retirement payment is higher. So that's a big difference and a significant filing strategy that you might use. And let me give you a quick example of how you might do that. My sister is a widow. Her husband's income was always smaller than hers. In a couple of years, she will max out her company pension plan, and she's going to be 63 years old. She plans to retire at that point and take the survivor benefits off of her husband, even though they will be reduced, and delay taking her own retirement benefits until she's 70, so she will earn that 32% bonus, and at 70, she will switch over to her higher ongoing payment. This allows her to have an income stream coming into her household for several years without impacting her ongoing higher Social Security payment. So that's just one thing you can do with the survivor payments that may give you some options on some of your clients. Now, we're going to talk about a couple of things that impact adversely survivor benefits or spouse payments, or your own retirement payment. If you receive a pension from an entity, a government entity, where you did not pay Social Security taxes, of common one in states, or maybe teachers, where they pay into their state retirement system, but the state does not participate in Social Security. That teacher does not pay into Social Security benefits. The first one that affects them is windfall elimination. And we'll just stay with the teacher for an example, if that teacher has also worked enough to have those 40 credits, they qualify for Social Security retirement payment on their own Social Security record, but that payment is reduced a maximum of $463 per month. But they will still get something on their Social Security retirement account. It will be reduced, but they still get something. If they worked and paid into Social Security for 30 years, that eliminates that reduction. So the windfall provision affects your own Social Security retirement payment if you receive a pension from an entity where you did not pay Social Security taxes. The other provision that impacts those growth is called government pension offset. That affects benefits you receive as a spouse or as a widow. If you are due spousal payments or survivor payments and you are receiving a government pension where you did not pay Social Security taxes, Social Security will take 2/3 of your monthly pension amount and subtract that dollar for dollar from any benefits you're due as a spouse or as a widow. And frequently it makes the Social Security payments zero. So under windfall, you will still receive something off of your Social Security retirement record. On government pension offset, it may completely eliminate the benefits you're due as a spouse or survivor payments on your spouse's Social Security record. Another thing that affects all beneficiaries, anyone receiving Social Security payments. If you are working and you have not reached your full retirement age, there are restrictions on your earned income from employment. In 2019, you can make $17,640. If you go over that, you lose $1 in benefits for every $2 you go over the limit. So if you file for benefits before your full retirement age, not only are you going to receive a reduced Social Security payment because you filed early, but you may not even receive all of your payments that month because of your working earnings. The only income that counts is employment income. Income that you pay FICA taxes on. So W-2 or Schedule SE. Income from other sources, annuities, investments, pension plans, that doesn't count here. The only thing that counts in this category is employment income. But then there are taxes. Your Social Security benefits could be taxable income. Social Security does not automatically take federal income tax out of Social Security payments. If you think you are taxable on your Social Security benefits, you can request that happen, but it must be a specific request from you. So how do you determine what's taxable? You take your adjusted gross income off your income tax. So your income from all your wages, your pensions, your investments, You also add in non-reportable income, tax-free interest on bonds. Take half of your Social Security payment and half of your spouse's Social Security payment. Add all these numbers together. For a couple filing joint, if it's less than $32,000, your Social Security benefits are not taxed. If it's between 32 and 44, 50% of your Social Security benefits are taxable income. If it's greater than 44,000, 85% of your benefits are taxable income, and you're taxed at whatever nominal tax bracket you fall into. About 30% of the population that receives Social Security payments pay some type of federal income tax on their benefits. So have your clients be aware of that so they know that these benefits could be taxed and they're not surprised at the end of the year. You can file for benefits, of course, in person, online, or by phone. One other question that you will be asked when you file for benefits, we've talked about spouses, but they'll also ask you, do you have any children? If you have children that are under 18, when you file for payments, they're due a check. They get an amount equal to 1/2 of your full retirement amount. If there's more than one child, that amount will be split equally between the children. If you have a child that is disabled, as long as that disability started before that child was age 22, and that child has never married, when you file for benefits, that child could receive benefits as a disabled child. So they will ask you about, do you have children under 18 or do you have children that are disabled? So just be aware that Social Security is going to ask questions to try to determine who is eligible for benefits on your record, how much can they receive, can they get benefits somewhere else, and their job is to pay you the maximum payment possible at that point in time. So I know it's a lot of information, a lot of questions and all. If you have questions following up, if you will get a hold of Allie or get a hold of your protective wholesaler, they can help you with Social Security issues, or if you have more extensive questions, if you send an email to Allie, they can get them forwarded to me, and we will try to get answers to your questions. So I guess at this point, we've got about 15 minutes left. I can answer as many questions as y'all still have.
Sure, I have one here for you, Jody. They asked, couldn't Social Security be completely whole if we removed the maximum compensation subject to Social Security taxes, which is now only $132,900?
The short answer is no. It would not.
I don't know if we're going to solve it here today, huh?
The actuary said that it would not completely cover the shortfall, that it would cover up about 60% of the shortfall, but you would either have to raise the tax rate or eliminate some types of benefits to cover everything if you just want to take the cap off the earnings like they do on the Medicare.
Gotcha. The next question is, if you filed early and you were born in 56, you cannot suspend or make up the difference and wait. Is that correct?
Read that again. You lost me.
No problem. I know it's a little confusing. If you filed early and you were born in 56, you cannot suspend or make up the difference and wait. Oh,
yes. No, you cannot. No. If you file early, maybe he didn't ask the right question. Regardless of when you were born, you cannot file and suspend anymore, period. That's gone.
It's gone, right.
If you file a claim for benefits and change your mind, you can undo it one time in your life. You must do it within 12 months of starting benefits. You have to pay back all the money you've received. There's no interest charge, but you pay back all the money you've received, and you can start over again at a later date. So you could eliminate your penalty by doing it that way, but your window to do that is just the first 12 months. Once you get past 12 months, you are locked in.
Gotcha.
So I don't really know what they were asking, but if they were asking about the redo, that's it. If they were asking about file and suspend, you cannot do that anymore, period.
Right. And then someone just asked me, I guess this question's for me, will the slides be available? What I'll do is I will convert this to a PDF. I send out an email to all attendees and people who missed out but registered with a link, and the presentation is available. You'll have to sign into our website, but it will be available on the back end of our website. I put the video up. So all of that will be able, you'll be able to download and re-look back at the slides if you have questions. I'm not seeing, oh wait, somebody else just wrote in. If one spouse dies young, age 50 for example, does Social Security make assumptions for future earnings when identifying highest 35 years for purposes of calculating the survivor benefit?
No, because what they do, they use a different formula, and if you die before you are 58 years old, you do not have to have 35 years of work. It will be based on maybe 31 or 32 years, because the assumption is you did not have an opportunity to work 35 years.
Gotcha. And let's see, right now I think that's all that I'm seeing for questions. So we thank you so much, Jody. This was great.
Okay. This is Mike. I want to make just a couple of observations real quick.
Sure.
One thing that came up for me a while back when I was doing this presentation, we had a veteran insurance agent. His wife had filed for Social Security. They had been given incorrect information. They had called, he called with her, and they were told by the person on the phone that it would be their highest last 5 years of income, which was incorrect. I asked Jody about that, and Jody, your recommendation was if you're unsure of what you're being told, make sure that you ask for a Social Security claims representative.
Claims representative, not a service representative.
Exactly. Don't
Two different job categories, and the
up.
training is
right.
noticeably different.
And then also, they won't coach a claimant. Is that correct?
That's correct.
They'll answer questions, but they're not going to coach you about what's best.
They will answer anything you ask, but they will not provide financial guidance.
Okay, so that's a value add that you as advisors can help with. You have resources with us where you know the questions to ask. You can submit your questions if you have questions that you can't answer in our materials. I would recommend you actually submit them to your relationship manager at Core Group, or with Alan, or send it to Alan Bradley rather than Allie. Send it to Alan or your relationship manager. They'll pass it on to me, and we'll get an answer for you if you have a complex question. But those two things I just want to point out. And with that, Allie, that's all my comments.
One more question just popped in, so I will pose this one. Husband is on Social Security disability, dies at age 62. Wife is 59. Can she claim the spousal benefit at 60?
No. Well, yeah, she can claim survivor benefits at 60. Yes.
Oh, survivor, yes. Mm-hmm. Okay. And
the other thing too, his disability benefits are not reduced because they started payments early. So her benefit would be based off of 100% of his amount, not a reduced amount.
Okay.
Disability benefits are determined as though you were full retirement age the day the disability began.
Okay. And then sorry, I skipped forward. More questions are popping in.
Good. I'm glad they're thinking about it.
Good, yeah. And then to follow up on that, the question was, can she claim on his Social Security disability at 60 and let her income grow by waiting on her benefit?
Yes, because she's getting a survivor payment. Remember, we talked about you can always pick and choose between the survivor payment and your own retirement.
This question's not fully clear. It just says restrictive benefits for both widow or divorced widow. I don't know. It doesn't really ask an exact question. So maybe, Carmen, maybe you can email us that question more specifically, because I'm not sure what that's referencing. Here's another question. If a client filed and suspended years ago and their younger spouse never filed, can the spouse file now that the client has just turned 70?
If they were at least 62. If the spouse is 62, they can file for benefits, yes.
Okay. Brian is back on the same, the question where the husband died and she waited till she turned 60 or 62. He says, so she would get his full DI benefit he was getting with no reduction, correct?
No, that's not what I said.
That's right.
If she filed for benefit for the spousal payments before her full retirement age, those benefits will be reduced. The base that you'll start on will be 100% of his payment. And then they will be reduced by whatever age she filed. So if she filed at 60 for those survivor benefits, she's going to take a 28.5% penalty. And then, but of course, she can let her own retirement continue to grow out as late as age 70 and then switch over. But if she takes any payment, any type of payment before her full retirement age, there will be a penalty.
Gotcha. Perfect. I think that officially does. Oh no. Okay. A lady at age 70 is working part-time. She's making $5,500 a year. That is more than some of the years she made 30 years ago. I think maybe they think that's higher. I don't know. Her benefit.
Well, remember
the
money that she made 30 years ago.
Right.
Has been indexed. So it may be worth more than the $5,000. But every year that she files income tax, Social Security will automatically look at what that was. So when you filed your 2018 income tax this summer, Social Security will automatically look at your 2018 number. And if it's higher than the lowest number that was used in your group of 35, then it replaces that low number, which causes your payments to automatically increase. If, in this lady's case, is the 5,500 is higher than her lowest number, then it causes her benefits to go up. If it's not higher, then it has no impact at all because it's always the highest 35 years, not the last 35 years. So any work she does could make her payment go up, but it will not cause it to go down.
Awesome.
That's assuming she hasn't filed yet.
Right.
Well, yes, but he said she's over 70. I assume she's filed.
Yeah. Okay, so I think we'll wrap that up. And then if other people have more specific cases and questions, like Mike said, please do make sure you reach out to your relationship manager or Alan Bradley, who will guide questions in the right direction. I know that there's a lot of specific cases that get a little bit more complicated. But we appreciate everyone joining us on the call. Again, this will be available, and I will email the link to everybody on the back end of our website. You'll just need to make sure you have a login to the core website to access it. And thanks, guys, for being here. We appreciate you so much.
You're welcome.
Have a great one, everybody.